Congratulations, everyone. We will be starting in a minute. All right. So, good morning, everyone, and welcome. Thank you so much for joining us today for a discussion on a topic that sits at the heart of all successful angel investors: building a startup portfolio that survives failure. When most people think about startup investing, they think about finding the next Flipkart or Zomato. But the reality is that successful angel investors do not succeed because startup investing or every startup becomes a winner. They build wealth because they understand how to manage risk, construct portfolios, intelligent winners to emerge. So, today in this webinar, we shall discuss and touch upon a variety of topics, including why startups fail, how experienced investors think about diversification, what to look for before investing, common mistakes that investors can make, and how long term returns are actually created. Now, before we begin, I would actually would like to understand the room here. Next slide, please. Which of these best describes you today? A, I have already invested in startups. B, I am considering my first angel investment. C, I advise clients or investors on allocation decisions. D, I am exploring whether startup investing can become a serious asset class for me or my clients. Please put your answers in the chat box with A, B, C, or D. And while everybody is putting their answers in the chat box, I just want to explain a quick disclaimer here that startup investing is not suitable for everyone. It's for investors who understand that this is high risk, illiquid, and for a long duration of time. But for investors who can allocate a small part of their overall portfolio, it can actually provide access to innovation, early stage growth, and businesses that may not be available in the listed markets. So I see that there are a lot of D's in the chat box. That means people are still exploring. All right. Thank you so much for your responses. And now, since all of you are exploring it seriously for the first time, that's why exactly we are conducting today's session. And joining me today are Suryansh and Shivam from our investment team. They have spent a significant time of their professional lives evaluating founders, business models, fundraising opportunities, and investment potential. Collectively, they have met thousands of founders, reviewed countless business models, and witnessed firsthand what separates promising startups from great businesses. Welcome, Suryansh and Shivam.
Thank you. Thank you for the great introduction, Anjali. I'm really looking forward for the discussion.
Thank you, Anjali. Looking forward to our conversation.
Thank you. So now before we jump onto our first segment of this session, I have another quick question for the audience. When you think of angel investing, what worries you the most? Next slide, please. Next slide, please. So, what worries you the most about angel investing? A, founder risk. B, valuation risk. C, illiquidity risk. D, sector risk. E, scalability risk. I would request the audience to please type their answers in the chat box. A, E, B, all. All right. So a variety of answers we have got for this particular question. That means there are definitely, there are people think that all of them are important or they are concentrated towards one, but definitely everybody is writing all of the options. So We'll try to address all of these throughout the discussion today, but I want to start with the biggest misconception. Most of the first time investors believe that I just need to find one winning startup. But is that really how startup investing works? Shivam?
Not really, Anjali. I know most of the audience here is exploring first time for the startup investing, but finding one winning startup is the most challenging or difficult job. I'll start with, let's say, most of the new startup. The biggest surprise for new investors is that startup investing comes with a lot of failures. Most startups don't end up giving strong returns to the investors, and that's completely normal. The real mistake is expecting every investment to make money for them.
I think I agree with Shivam. The objective here is not to avoid failures. The objective in angel investing is to build a portfolio where a few winners can make more than the losers lose and compensate for the investments that don't work out. And that's the main reason why startup investing is fundamentally different from traditional investing.
Right. So, from what you two have said, I think you guys are trying to say is that failure is not the exception, but it's actually built into the asset class.
Absolutely, Anjali. Whenever you're investing, the real question isn't whether some startups will fail. The real question is whether your portfolio is diversified enough to handle those failures and still generate strong returns for you.
Right. That's definitely something to think about. Thank you for your insights. Now, I would like to take a pause here, and I would like to ask another question to our audience before we move on to our next segment. Can we have the next slide, please? Now, suppose you have 25 lakhs to allocate to startup investing over time. How would you invest it? A, 25 lakh in one very promising startup. B, 5 lakh each in 5 startups. C, 1 to 2 lakhs each across a larger portfolio over time. Please put your answers in the chat box with either A, B, or C. B. B. Okay. We do have a wise audience. Great. Though there is no perfect answer, but your responses are telling us how you naturally think about risk. All right, great. Thank you so much for your responses. Now, based on your answers, I want to touch upon our next segment, which is the power law. Now, this is something many investors, hear about because it's a fancy phrase, but they not fully understand. So, Suryansh, any thoughts on this? The power law.
Sure. I think this was fairly a very new word for me also when I started investing. But in venture capital, the power law is a principle stating that a small fraction of your investments, typically 10%, will generate the vast majority of your returns, and they will often vastly outperform all other investments and failed startups combined. So,
Right.
power law is something that essentially drives venture investing, right? Imagine you invest in 10 startups, and realistically talking, the outcomes can be that 6 may fail, 2 may return your
Correct.
capital, 1 may return decent gains, and 1 may generate the majority of your portfolio returns. And that is exactly how venture outcomes work.
So, Suryansh, you said that one startup may generate majority of the returns. Then why would somebody not invest in that particular one startup only that will generate those outlier returns? Why do you need to diversify? Shivam, can I have some thoughts from you on this?
Yep, Anjali, finding out that one outlier company is the most difficult job. I'll explain you with an example. Let's say an investor puts all their investment capital into just one two startup and hoping that they will turn out to be outlier in the future. The risk is very high here. And but if the same amount, let's say, if you put it across 10 or 15 startup, let's say 20 startup, the chances of backing a successful company increase significantly.
Correct. So, what do you think would be a reasonable portfolio size, Suryan?
So this is a very subjective point, and it depends
Yeah.
on person to person with their investable amounts. But for most investors, what I've seen is that 10 startups should be a minimum starting point. A portfolio which has 10 to 25 startups creates reasonable diversification. But again, I think there is no short answer to this question. But diversifying in number of companies and secondly number of sectors would create a decent chance of making good enough returns. And I also feel that the idea is not to predict perfectly, but the idea should be to increase your exposure to quality opportunities.
So, okay, suppose I have, a good amount of surplus today for startup investing. Should I invest all my investable money in one go? Shivam, any thoughts?
Anjali, that is a very important question. I
Yeah.
suggest investing in 10 or 12 startups every year and keep doing that same for the next 3-4 years. From the fifth
Okay.
year onward, investor can expect you'll start seeing the cycle of returns as well as the failures. And this is what most of the experienced investor out there are doing the same. Sometimes your best returns come from being patient with companies that are proving themselves over time. It is a cycle which will take time, and you should be patient enough to wait for that timeline.
Got it. So, quality opportunities, diversification, patience. It's a game about all of it. Great perspective. Thank you so much. So, let's move on to our next section. And again, I'll bother my audience with a question again. Before you invest in a startup, what do you think is the most important factor to look at? A, founder market fit. B, product market fit. C, unit economics. D, scalability. E, governance. I would request my audience to once again please put your answers in the chat box. Okay. Devraj ji says all. All. We have not given an option of all, but the audience is still going for all. That's quite impressive. C and D. All right. Thank you so much for your answers again. Let's now dig deeper into evaluation, which is our next section, evaluating the opportunities better. So, when founders pitch, what do you, Shivam, personally look at? The founder first or the business first?
So, Anjali, for me, the founder comes first. However, I agree with the audience. They are saying that we should be focusing on each and every point that is mentioned here. But when you are evaluating an early stage deal,
Yeah.
you do not have any visibility around the future because you're talking to a founder who has a vision and he is going to build a business around it. Right? So it becomes very important to understand the vision of the founder and evaluating the founders, because ultimately they are the one who is going to drive this entire business to the next few years and then taking it to the next level or raising funds and turning it into a unicorn, right? So for me, always the founder comes first. At the early stage, market can change, regulations can shift, and external events can impact the business, but the founder is the one constant. That is why we here at Jindagi Life Angel Fund spend a lot of time understanding the person behind the company and asking certain questions to evaluate them. Let's say, can they execute whatever they're trying to build? Are they adaptive enough to face the changes? Do they understand the market deeply? And can they attract great talent?
Right.
I think I'll also like to add something. I completely agree with Shivam. And after evaluating the founder, then I think we move to the product market fit, right? even a great founder will struggle in a tiny market, right? No matter how good the business is. But if there is not a caterable audience for that, they will definitely struggle. And after evaluating the founder, we look at whether the problem is genuine and worth solving for. If the answer to that question is yes, we then look at if there is a large opportunity size, if there is a growing demand, and if the business model is scalable or not.
Right, right. So you guys talked about founder market fit and product market fit. So once these are established, will you just go ahead and invest? Will this be enough for you?
No, not really, Anjali. These two are the just a starting point. And once
Okay.
you're confident on the team is good, the product and the founder market fit or product market fit is there,
Yeah.
and that is the starting point. That's when you start digging deeper into the opportunity. You do DD, due diligence, and checking for the other red flags.
So that means your job is not done there yet. So you talked about red flags. Can you just let me know what some of these red flags would be?
Yeah, sure. So the biggest red flags are the founder dispute and poor governance. You can relate with, let's say, pick an example of Blue Smart Mobility.
Yeah.
So it's a good company. They were scaling, they were doing good, raising funding. And the one thing that they were ignoring was the corporate governance, which
Hmm.
is a most important part of the business. And that is governance was something that led to the failure of the company. So
Hmm.
governance and founder dispute most of the time destroy a successful startup as well. We
Hmm.
also pay close attention to the founders who
Hmm.
keep on changing the direction and those who don't have a clear understanding of their unit economics. And we
Suryansh
can talk about a
would
bunch of other red flags as well.
yeah.
Are you saying something, Shivam?
No, go on, please.
Okay. I think one lesson that we as investors have learned repeatedly is that we should never get carried away by great storytelling alone. Great stories are helpful, but the strong execution is actually what creates value.
Right. I absolutely agree. And there is another area that I would want to talk about because many investors struggle about this fancy term of valuation. So, how should investors think about startup evaluations? Sorry, valuations.
So again, as the slide says, that startup valuation is not an exact science, right? Here,
Yeah.
one plus one is not two, and it is influenced by a variety of things, right? It is
Hmm.
influenced by growth, it is influenced by market opportunity, it is influenced by comparable companies, it is influenced by fundraising environment. But there is one important principle here to note is that a great startup can still be a very poor investment if you overpay, right? So you should definitely, while evaluating a company, focus a lot on valuation and see if you're overpaying for it or not.
Right, right. I think I completely agree with you. And so kudos to our audience also, all of those who said that all factors are important as we displayed in our question in the beginning of this segment. And clearly, you two have also mentioned all of the points. I believe none of them could be ignored, right?
Exactly.
Yeah,
Absolutely.
yeah, right. So let's move on to our next segment. A lot of individuals, tend to avoid investing in startups directly. I want to touch upon this because a lot of our audience today, they are individual investors, and there are so many points that they see as hurdles, that they see as obstacles to directly investing into startups. Because whenever an individual investor goes the direct path, these hurdles seem to them like a cost, because there's a lot of effort that goes into it. There's the effort of a lot of time. Can I have the next slide, please? Thank you. There's time to find opportunities, and the number of opportunities also. Now, how can an individual receive or get a pipeline of good quality opportunities to actually decide whether something is good or not? And then there is this effort of going through a legal review, going through documentations, going through valuations, and doing deeper dives into due diligence. And an individual may not even be an expert on all the sectors, right? Even if we talk about a doctor in some specific field, he will have his own set of knowledge, and maybe he can evaluate startups in his own field. But will he be able to evaluate an AI deal, or will he be able to evaluate something in fintech? The answer is no. So that means all of these barriers, all of these hurdles are stopping, or are the reasons why, because of these efforts being very real, individual investors are tending to avoid angel investing in general. Any thoughts on this, Shivam?
Exactly, Anjali. For most of investors out there, evaluating one startup on your own may seem easy, but building a portfolio of 10, 15, or 20 startup is much more challenging. You may be expert in one sector, but you cannot be expert in other sector. So you need to find opportunity across the sector. And that is when you need access to quality deal, proper screening, due diligence, documentation, portfolio tracking, and regular updates. And that is where a fund comes into play. A fund like Zindagi Life Angel Fund, which brings all these activities under one structure, making the process much efficient for the investors.
But
Right.
that doesn't mean that the fund route eliminates risk or that effort should be ignored, right?
Yeah.
Investors should always understand that this particular effort is the reason why fee structure exists, right?
Right.
But the right way to look at it is this, right? In startup investing, disciplined access and evaluation have value. The question isn't only what's the fee. The better question to ask here would be what process, access, governance, and support am I getting for that cost?
Right. So it's definitely important to understand that the efforts are real, and so is the cost. So thank you for the insights on this. In direct angel investing, the investors bear the entire responsibility individually, right? As you have said. But in an organized structure, or in an organized fund structure, the investor participates through a defined process where sourcing, filtering, documentation, portfolio communication, and ongoing monitoring are handled more systematically, because there's an organized structure in place. So the cost is not just a charge, but it also about building a more organized and disciplined investment journey in the long term. And here at Zindagi Life Angel Fund, our effort is to help the investors approach startup investing with the same discipline, patience, and proper portfolio thinking. And we are not saying that startup investing is risk free. It is absolutely not. And one should prepare themselves accordingly. But for investors who understand this calculated risk rather, have a long term mindset, and want structured access to curated startup opportunities, an organized fund route can actually make their journey much more easier, informed, and manageable. So let's move on to another very important segment of today's session. Uh, Perhaps the most important question, that when do investors actually make money from startup investments? Suryansh.
I think you're right. This is perhaps the most important question. We are all here to make money at the end of the day. And in angel investments, money is typically made through acquisitions. There can be secondary sales, or if a company goes to IPO. But saying all that, investors still need realistic expectations. Startup investing is a very long duration asset class, and returns usually start coming in from the fifth year onwards.
I think Suryansh, you rightly mentioned, you can expect an exit through acquisition, secondary sales, or IPO. But the one thing, to get that exit, you need to be patient.
Yeah.
And that's when patience is a key part of startup investing. The biggest success stories often take many years to emerge. I have learned I have learned one thing, that angel investing should be only a small part of your portfolio, not the main part.
Hmm.
The amount
Right.
invested should depend on the investor risk appetite, financial situations, and long-term goals. Most importantly, invest only money that you can afford to keep locked in for several years, and avoid putting too much money of your portfolio into startup, because at the end of the day, startup investment is a risky investment.
Correct. Absolutely. That's quite some insight and feedback, and one should definitely keep all of this in mind. And before we end today's session, there is a topic that is talk of the town, and especially among the investor community, which is on accreditation of investors for angel investing. So, who can really invest in startups? Now, SEBI has recently come up with a regulation that says that post September 2026, only accredited investors will be able to invest in startups. Now, this accreditation is based on either income or net worth, or a combination of both. Assuming that most of our audience are individuals, we are showcasing the eligibility criteria, which is based on annual income, either greater than or equal to 2 crores. If only net worth, then greater than or equal to 7.5 crores. If there is a combination of income plus net worth, then income of 1 crore and a net worth of 5 crores. So this is individuals. If one of you are looking to invest in individual capacity, then this applies to you. And if you'd like to discuss the end-to-end process in detail, our team can definitely connect with you after the session or at any time of your convenience. You could drop your contact details to Anjali and post it on the chat box directly to me rather than to everybody. Thank you so much. And just before we close, we want to leave everyone with a simple checklist of how we promised you at the starting of this session, that before making any startup investment, you must ask, does this fit your portfolio strategy? Is the founder exceptional? Is the market large enough? Is the valuation reasonable? Have you understood the legal structure? And are you prepared to be invested for a long term? Very, very important. And another, perhaps the most important question would be, can this become a meaningful winner for you? So all of these questions become very important, that you understand, not just understand, but keep in mind in the long term whenever you are going for startup investing. Because ultimately, the goal is not avoiding failures. The goal is to build a strong enough portfolio that the failure would not matter. And the portfolio would actually give you a winner at the end of the day. Right. And at Zindagi Life Angel Fund, our effort is to help investors approach this asset class with discipline rather than excitement alone. And if today's discussion has sparked your interest in angel investing, you can please scan the QR to fill a simple interest form as shown in this slide. And those who wish to directly explore startup investing with us through Zindagi Life Angel Fund, they can indicate their interest in the form, and our investor relations team would love to separately connect with you to explain eligibility, documentation, structuring, and the upcoming opportunities. We now open the floor for questions, please. The audience can put their questions in the chat box or directly unmute themselves to ask. We would love to take your questions. And I think there are already so Devraj is saying that angel investor aggregators can provide these services through their platforms. Now, sir, with aggregators, those are again direct investments in the startups. And if there's just an aggregator platform, you again would have to commit a much larger ticket, a much larger check size to be able to participate in a startup investment. You wouldn't be able to come into the picture with a very small ticket, with which is what today's investors, want. They want to invest a minimum so that they are able to diversify into a portfolio of say 15 to 20 startups over time. There is another question in the chat box. What are the sectors you are looking at for the next 5 years? Shivam, Suryansh, anybody, would you like?
I think I'll take this.
Yeah.
So for the next 5 years, there are many promising sectors, and we as an angel fund are closely looking at it. I'll pick certain sectors, which is, let's say, defense tech, AI. When I say AI is a very broad term, because at the end of the day, AI is enabling all the sectors out there. But specifically, manufacturing is something which can create a huge or multiple unicorns in it. Any startup who is using AI to enabling or making much more efficient the entire manufacturing process would be a real-time or long-time winner. Apart from manufacturing, they are also closely looking at the health tech, fintech, and of course, in agri-tech, any startups out there who is enabling or solving the supply chain issue, we are closely looking at that. But again, this will keep on changing given the dynamics of the market and the regulation, a lot of other external factors, which will decide what we are going to pick in next 5 years. So this is not constant something, but at this point of time, given the kind of policies government has defined for the AI adoption, for the other sectors where AI is actually enabling it. So of course, AI, defense tech, health tech, agri-tech, and supply chain.
Okay, thank you so much, Shivam. I think Devraj sir has written 3.5 lakhs minimum. Sir, could you please maybe unmute yourself and let us know this is in context too?
Yes, this is regarding the aggregators platform that we were talking about.
Yeah.
In continuation to that, see, there are platforms where the platform will do all the due diligence and even select the startup for their set of investors to come on call and evaluate those startups. They will also put in a little bit of their money in if they feel that the opportunity is very good. That is how they attract their customers who are open to this asset class. And there, the minimum ticket sizes, they have to put in 25 lakhs over a period of 5 years.
Yeah.
So that's how they evaluate various startups. And it is now possible, all the due diligence, legality that we were talking about, all that is done by these platforms.
Right. So, sir, I think you're using a more broader term of platforms, and we are talking about fund, which is, of course, AIF, Alternate Investment Fund, is one such option, right? Yeah. So I think we are aligned in what we are saying, because you could invest in you could enter a startup investment asset class with a very small amount, and you have mentioned 3.5 lakhs. Rather, at Zindagi Life Angel Fund, our minimum deal ticket comes down to as low as 1.5 lakhs also. So that means the access to investors is more diversified, and people can definitely, as you know, Shivam and Suryansh have harped enough on diversification, on patience, on how not concentrating your entire amount into very limited startups. So all of those points in what you have said absolutely harmonize with what our session wants to actually deliver to the audience.
Correct.
So thank you for pointing that out. We'd love to, if you want to add up something more, would love to hear that.
No, I mean, the only thing, I still prefer to go through the fund route. The fund route is far better because they are professionals evaluating startups, and then you put in a crore.
Absolutely, sir. Absolutely. That is why, individuals tend to avoid going directly, because nobody has that kind of effort, that kind of actually time to put in that effort, or expertise to put in that effort to go through this end-to-end process for say years of time, right? That is why the fund route definitely helps. Yeah.
That's correct.
Yeah. Thank you so much, sir.
Most welcome.
Moving on to the next question from the chat box, Mr. Siddhesh wants to ask, what would be the least requirement of investment amount in startups? So, sir, in terms of, I'd like to take this question for you. If I talk about SEBI regulations, then earlier, yes, there was a minimum commitment for angel funds per se, which was 25 lakhs. SEBI, which has been recently removed by SEBI, so now there is no minimum commitment to be made if you're choosing the fund route. But definitely, if I speak about what Suryansh and Shivam have also said, the minimum ticket our fund allows is 1.5 lakh in each deal. But it wouldn't make sense if you just invest 1.5 lakh in say 2 or 3 or 4 deals, because then again your investment is concentrated. What you want is a manageable portfolio. What you want is a diversified portfolio. So definitely, over a period of time, you can easily invest 20-25 lakhs to make a sensible portfolio. If you have any follow-on questions on this, please let us know. So Mr. Devraj has another question regarding the return of capital and returns. How does it work? So, startup investing, definitely this is quite a subjective question. So, if I talk about our fund, we target an XIRR of about 35%, and unlike CAT2 or unlike private credit funds, we don't say that your capital would be returned after 5 years. The money is locked in for about 5 to 6 years, depending upon the startups you have invested in, because as we had shown in one of the slides, that you keep investing for a period of 3 to 4 years, and in the 5th year onwards the returns start coming in, right? And these returns are in the form of exit strategies, which could either be say buyouts, acquisitions, IPOs, or secondary sales. So whenever this happens, for example, say we are angel investors, okay? We invested in a seed round for a company. So we invested very early on in the journey for a small round that the company was raising. Now, 4 years down the line, the company has grown immensely, and bigger VC comes into play who's infusing say 200 crores into the company. Now, out of that 200 crores, there could be a secondary sale that could happen, that the majority of the infusion of 200 crore is used as fresh primary capital, and say 20 crores is given out to the angels who had participated in the seed round as an exit. So similarly, there are various exit scenarios that come into the play, and that's how returns take place. Hope we were able to answer your questions. If you have any follow-ons, please do let us know. I'm now taking the next question from Mehek. What's one mistake almost every first-time angel investor makes?
Anjali, I think I'll take this one.
Sure.
So what I have seen is most of the angel investors, they do not diversify their portfolio. And apart from diversification, they also expect a quick return from startup investing, which is not possible. I'll tell you one story. We recently invested in a company called Psychedelic, which is into neurotech space, a deep tech company. And I was when we were raising funds for this company, I connected with one investor. He was saying that I want to put a bet on a deep tech company, and I want a quick return, maybe in next 1 year, 10 or 15 or 30x return, which is not possible in startup investing. And this is what happens when an angel investor will start investing. They hardly make 2-3 investment, and then they start expecting we'll get a return in next 1 or 2 years. No, that is not the case. Here, your capital, as Anjali also rightly mentioned, the capital is locked in for minimum 4 to 5 years. And of course, there are chances where one of your companies got acquired by someone, let's say after 2 or 3 years of investment, you'll get your exit. But most ideal scenario is you should keep in mind that your capital is going to be invested in for next 5 years.
I think if I add something to that, a lot of angel investors I've only seen glorified stories that an X amount invested in Zomato could be worth this much if you had invested at the right point of time. But there are not enough failure stories around startup investing. We've already seen glorified stories, right? So it is important to mentally prepare yourself that not every investment is going to work. And you, as Shivam rightly mentioned, that you have to diversify your portfolio very well.
Right, right, right. Thank you. Hope that answers your question, Mehak. Please let us know if you have any follow-on questions. We have another question by a user from Redmi9. How angel syndicates can help us in angel investing? So, sir, again, this is a question similar to what Devraj sir had questioned. Syndicate is a different format from a fund. Again, in a syndicate format, you directly invest into a startup and come onto their cap table. And therein, the entry, again, there is some entry barrier because there is a ticket size that you must meet to participate in a startup and come on their cap table directly. So you come with a considerable ticket size, and that's how for angel investing, angel funds become a better route than syndicates if you are a low ticket investor, right? Or if you want better diversification. And that's how, and that's what is recommended as well. In terms of overall help, if I talk about whether it is syndicate, whether it is funds, yes, there is a lot of quality opportunities that come onto your table that have been filtered, that have been where the entire due diligence has already been done. Such kind of opportunities will only come onto your table, and you can easily decide whether you want to go ahead with that opportunity or not. And there will be a constant monitoring done even after the investments. So all of this you will not be able to do in your individual capacity, and that's how AIFs and angel funds are a better way to start your angel investment journey. If you'd like to understand this in more detail, we are more than happy to get on a call with you one-to-one. It would be great if you could just drop in your contact number to me directly in the chat box or to Yash. Thank you. There's another question in the chat box I'd like to take up. When you meet a founder for the first time, what's the one thing you are trying to understand within the first 10 minutes? Okay, I think maybe Shivam can answer this one.
Sure. So whenever we are meeting to a founder for the first time, so we try to assess whether their vision is clearly aligned with whatever they are trying to solve. And to do that, you need to check whether the founder clearly understand the problem that they are trying to solve. And the second point is, do they also understand the customer that they are supposed to cater? Because these are the two driving factor for your business. If you have clarity about the problem that is there in the market and that you are trying to solve, and you are also a consumer mindset, I think you're good to go.
Thank you, Shivam. Now, moving on to our next question, which is again from the Redmi user. Does co-partnership opportunity via venture studios works out well in angel investing? Suryansh, Shivam.
As of now, we are independently working as a fund. I don't know what kind of venture studio. If you are representing such one venture studio, then can you explain what kind of partnership you are talking about? Of course, if there is something, we would be open to collaborate and explore more. But again, as a fund, if anyone out there who can provide some sort of a support or some help to our portfolio company, we are always open for partnership.
Thank you, Shivam. We have another question from Swati. Have you ever changed your mind about a startup during due diligence? What caused that change? I think that's a lovely question.
Yeah, I think most of the startups, when we go and dig deeper about the financials, about the market, about the customer that they're catering, and 10 different other metrics, this is the time when most of the time the decision making happens here on, because that's when you get to know, because now you have the entire data room of a startup and you are sitting with your team and evaluating each and every aspect. So this is very likely most of the time you made up your mind here and you say no to the startup. This is one of the most critical part of the evaluation also.
Right. Would you like to add something, Suryansh?
No, I think Shivam has covered everything.
Great.
That's my same word.
Great. Thank you. Next question is from Vanshika. As an investor, what is your biggest hesitation about investing in startups?
I think, again, we are a little skeptical sometimes if the founder actually understands his or her business very well. So, again, as we mentioned in the webinar, the first thing that we look as an angel fund is founders first, right? So no matter how much time we take to evaluate the founders, we want to make sure that we have understand that the founder knows what he's trying to solve, he or them is trying to solve, and if they are able to do it correctly.
And to add on Suryansh's point, no matter how prepared you are or how much evaluation or DD you have done about a startup, there is no sure shot answer that whether this startup will succeed or in the future. Sorry. So that's all.
Next question again is from Mr. Sidhesh. What's the exit plan? Is it easy go or it depends on following seed rounds?
I think yeah,
go
please go on.
Okay, I'll take this one. I think exits are very subjective, right? I mean, a company that we recently invested in a month ago is now preparing for a much larger round at a much larger valuation, right? So in this case, the exit to our current investors would be fairly soon, and the IRR would be a lot. But in some cases, the company, let's say, raises another round in the next 3 to 4 years. And then also the investors have a decision to make, right? Do we want to take out our money at this point of time, or do we see much more potential, right? So I think it varies case to case, and we would probably evaluate everything from a different lens, depending on the sector that we've invested in.
Right. So there are a couple of more questions from the Reddemi user. So would you like to maybe unmute yourself and have a conversation? All right, I think I'll just read out the question then in that case. What's the difference between investing through a venture studio and investing through an angel fund?
I think we have. So venture studio is something where they are not just, maybe sometimes they will not invest money in your startup, but they'll give you the platform, the connections at a very early stage, and side by side they'll also give you a small amount of money to actually put your thoughts or ideas into action or execute that. But the moment you're ready with your prototype or ready with MVP, you need certain capital to go actually out there in the market and scale your business. So venture studio, they position themselves as a studio where you can incubate your startup. If you need any resources, they can provide that. But angel investing is one step ahead of that, where they will invest in your startup, and after investment also provide you all the strategic support, all the, not about the resources, but any kind of partnership that can change the direction of the startup. They'll do that for you. They'll find the good connects for you. They'll also form the big partnerships for you. apart from money.
Thank you, Shivam. Can you also take up the next question, which says the difference between entering through equity crowd funds compared to angel fund?
Yeah, sure. So equity crowd funds is a kind of structure where all the people who is investing through this fund, they'll be appear on your cap table, which at the later part of the journey for a startup becomes very difficult to having a lot of people on your cap table. But what happens with angel fund is that we may be collecting we may be collecting money from the 100 plus investor or 40 50 plus investor, but on cap table there will be one single entry from the fund's name, and we will represent the rights of the investor in the company boardroom. We have a better negotiation power than equity crowd funds, and of course it is good for startups as well, because they are not making their cap table crowded, because there is just one single entry from the fund's name.
And I think if you, let's say, take an entry through equity crowd funds, the process is usually less structured. I mean, they're going to show you every deal that they get. I mean, it's just a platform, right, of showing deals versus the angel investors, right? So they are going to show you every deal that they get. There is not going to be any negotiation on the valuation part. There is not going to be a structured deal flow. And versus if you come in through an angel fund, right, there's going to be structured deal flow. You would be able to diversify your portfolio better. And of course, we'll also negotiate the valuation part for you.
Right. Thank you. Thank you, Shivam and Suryansh. Mr. Devraj wants to ask, in angel fund, if one invests over a period of 3 to 4 years, what is the minimum amount per investment? Per investment, sir, as we said earlier, would be 1.5 lakhs. You can then increase it in the multiples of 10,000 thereof. To the next question, how do you connect with us if you come up with a new startup? Is it on a regular basis, or are there any general communication mode? So I'll take this up. Sir, if you become part of the startup, and if you become part of the fund and get onboarded as an investor, then of course there is a very streamlined communication that goes to you. Firstly, there is an investor dashboard that we have. This is an online dashboard which has covers or showcases your entire end-to-end journey with us, and it will also showcase you all the live opportunity details. Moreover, there are official WhatsApp groups and emails wherein these communications go out that so and so company or so and so startup deals are available to invest. And the best part, we do webinars, or you can say we do pitch calls, wherein the founder of that particular startup would come in to directly pitch their businesses to the investors. So there are founders on one hand and investors on the other hand on the call. This is, you could imagine this like a virtual Shark Tank episode, wherein a pitch happens and then there is a Q&A that happens. So various forms of communication and to keep you in loop. And of course, apart from this, our investor relations team keeps in touch with you so that you are up to date, you are up to speed with all the information and all the opportunities that the fund is presenting to you. Hope that answers. If you'd like to know more, would love to connect with you separately, you can drop in your contact number to me directly. Thank you. Mr. Raman Gupta is asking, what is the tentative ROI given by your angel fund to the investors in the past 5 years? So, sir, our fund will turn 2 years old soon. So, earlier we used to invest through a syndicate format. So, we are not new to angel startup investing. We have been doing it for the last 4 or 5 years. And the XIR is somewhere between over 35%. Thank you. Another question from the Redmi user: what kind of IRR numbers angel investors should keep in mind while looking out for investments into startups? Shivam or Suryansh, would you like to take this up, please?
Yeah, sure. So I think if you are investing in each and every deal. That is why we are saying that diversification is one of the most critical point of investing. So make sure you are
Shivam,
investing
I
in
think
all
there
of
is
them.
some connection issue.
Am I audible now? Can you hear me?
Yeah. Yes.
Okay. So I'll start again. So the return of an angel fund depends on, or what you can expect from us is also depends on how actively you are investing in the opportunities that we are showing it to you. Because most of the time what happens is there is a one investor, let's say, who start investing with us. For first 2-3 investment he is investing, but and then he start expecting now I have already done 2-3 investment, I'll wait for some time and I'll get some return, then I'll again start investing. That is not the case. We are focusing on the diversification, so we will encourage you to invest all the opportunities that we are showing to you. And if you are doing that, then you can expect a decent amount of return, XIR that Anjali mentioned, 25 to 35 range. But again, there is always an exception. If you are investing, let's say 10 or 15 companies that we have shown to you over a period of, let's say, 1 or 2 years, and if you are investing in all of them, and even a one single company turns out to be a big success, or end up raising big institutional money, then this XIRR is just a number. You can get 200, 300, 500. You have already seen a lot of stories like this. So that is something which again depends on how actively you are investing.
Right. Thank you, Shivam. This question from Sid. Is there any benefit of becoming an accredited investor? Is it necessary to get into angel investing? Yes, to answer your first question, it is necessary to be accredited and for angel investing from September 2026 onwards. Not right now, but yes, from September. So within July and August, if you want to invest in some opportunities, you can do so whether you are accredited or not. You wouldn't be able to do so post September 2026. Benefits, we can definitely get in touch directly, but just to briefly tell you, there are many benefits spread across that SEBI has given for accredited investors. Like PMS, a minimum of 50 lakhs is required to participate in this product. But if you're an accredited investor, you could invest as low as 10 lakhs. This is, of course, as per the discretion of the fund manager of that particular PMS. And if I talk about entry into CAT2 AIFs, CAT2 AIFs, as per SEBI, this is a regulation that it is mandatory that your minimum entry check size is 1 CR. However, SEBI has given a relaxation to accredited investors. If anybody is accredited, they can enter even CAT2 AIFs, which is 25 lakhs. So, like that, there are many more benefits. Would love to directly contact with you, sir. Your next point is, so every investor can have a different portfolio and it's not a common portfolio for all the investors. Definitely, sir. We, as a fund, we only showcase investable opportunities. At the end of the day, you can definitely decide whether you want to put that in your portfolio or not. What are the live opportunities with you at the moment? Sir would love to contact you directly post this session and have a direct call with you, and we can discuss our live opportunities. For the audience here, I can just take a quick example. One of our live opportunities that we were investing in, it is a D2C wellness brand that is on an ARR of over 45 crores right now, being early stage, and they have also turned EBITDA profitable very early on in their journey. We talked about a lot of factors that you should keep in mind when you're evaluating startups here, and one of them was unit economics. That means very early on in their journey, the company is focusing on their unit economics. The total rounds the company was raising was about 10 crores, and they already have 8.5 crores in the bank, wherein the round is led by Unilever Ventures. That brings in a lot of validation and credibility to the kind of opportunity we are presenting to our set of investors. I would personally love to connect with you to discuss this opportunity in detail. Thank you. What is the corpus of this fund, Mr. Devraj? Sir, the corpus of Zindagi Life Angel Fund is 100 crores. We also have a green shoe option of 100 crores, which means that any point in time we can extend our total outlay to total of 200 crores, not exceeding that. Thank you. Any more questions? We would connect with you directly also, or you could unmute yourself to ask your questions to either Shivam, Suryansh, or me. Let's wait a couple of seconds if anybody wants to put in more questions. In the meantime, I would request all our participants and audience to please scan the feedback or the interest form. If you want to explore startups, we would love to connect with you. And if you could take out a minute to quickly fill out this form. We also have a QR code on the screen for our Zindagi Life Angel Fund's LinkedIn page. Please follow it, and you would get, good insights. You would get to know the flavor of companies we are investing in. You would also be able to understand the rationale behind it. So please follow our LinkedIn page. Thank you. Thank you so much for your kind words, Devraj sir. So the username with govind.universe, how do founders reach out to your team? So you could directly email us. You could land over to our fund's LinkedIn page. You could DM us there. I can offer our investment team, and you could directly email us with your pitch deck, and we would love to evaluate your startup. Thank you so much, Mr. Siddesh. We've received your phone number and email address. Would love to connect with you after the session. I would really appreciate you if you could just take out a quick minute to scan the interest form and fill it out for us. Thank you. Okay, there is one question that I have missed. Do you go through a meticulous screening before pitching to your investors? What does this include? Definitely, we do go through a meticulous screening process, sir. Suryansh, would you like to give out more details, please?
Sure. I mean, as mentioned in the webinar, there is a very detailed due diligence that we do. But let's say if I have to sum up what we try to do before showing the company to our investors, there is a basic framework that we follow. It's called the 5T process, which includes team, traction, tech, thesis, timing, and then also there is an additional T called TAM, total addressable market. So we try to checklist all the 6 or 5 boxes, whatever we try to look at, depending on the sector or the company that has come to us. And then if it checks most of the boxes, and it matches with our thesis of being an early stage company that has the potential to come into the market and capture a major chunk of it, we then try and go and pitch it to our investors.
Right. Thank you, Suryansh. Hope that answers your question, sir. All right. So thank you so much to our audience for being so enthusiastic and so sporty in terms of answering all our audience polls and being very passionate about asking the questions in the chat box. This actually means that you could get some takeaways from today's session. And thanks a lot to Suryansh and Shivam for sharing your insights and sharing your experiences with absolutely relatable examples. And we look forward to having more such conversations and helping investors approach startup investing with discipline, patience, and conviction. And have a great day and a great weekend ahead. We would love to connect with all of the participants separately post the session. Thank you so much.
Thanks, Anjali.
Thank you very much.
Thank you.